Hello, everyone. We appreciate you joining our September market update webinar today. My name is Matt Clifford. I'm a portfolio manager at City National Rockdale. I'm joined by key leaders of the CNR investment strategy team, including CIO Charles Luke, senior economist and senior portfolio manager Paul Single, and director of fixed income Mike Taylor. The views and estimates you hear today are sourced from our investment committee's weekly meetings, and we'll discuss CNR's perspective on what's in store for the economy and financial markets and the implications for client portfolios during the webinar. At the end of the presentation, we'll all be on the line to answer any questions you receive during the webinar, so please type them into the console's Q&A window at any time during the session. You can also download the presentation materials using the download window at the top of the console. And now I'll turn the call over to Charles Luke. Charles.
Great, thanks a lot, Matt. And thank you everybody for joining today. First off, I just have to start with, it's been a fantastic quarter. So rolling up into the end of September, it's really been, I think, a special move in the markets. Equities have certainly continued to climb. We are seeing positive signs of a pretty good setup going into 2026. And so, as always, we're going to start with the speedometers, and we have made some more upgrades for this month. So on consumer spending, you'll see it right in the middle of the page. It's definitely held up better than expected this year. If we look at the administration sort of coming fiscal spending bill, the elevated wages that we've seen are all providing support for higher and middle income groups, so that's a real positive. We're also seeing some survey-based measures for the top third of earners, definitely becoming a little bit more confident in their future income prospects. And they do drive the bulk of consumer spending, so that's another positive. And then last week, we got measures of retail sales, which did come in above expectations. And consumer surveys now that we monitor are showing optimism is definitely building, as a lot of the stimulus measures do take effect going into the first quarter of 2026. And then, of course, everybody knows what's happening with the Fed, so lower interest rates are definitely likely to help here. And that's a good segue into the second speedometer that we've upgraded. So if you look just to the right of consumer spending, you'll see that we've upgraded the September interest rate speedometer. So we have Fed cuts here in September for the first time since 2023. We've had a resumption of the easing cycle that's expected to continue into 2026. And if you look at the top left-hand side here, we did recently go green on monetary policy, so that's another positive. So if we look at lower interest rates from the Fed, it is easing financial conditions. Equity markets, as I mentioned, are making new highs. And if we look at credit, the measure of spreads, which is basically an implied risk in the credit markets, is also at a really good level fundamentally. We're also seeing housing respond very quickly to the level of interest rates. New home sales just this month surged substantially, up about 20%. And then refinancing activity is set to accelerate. We saw mortgage applications go up to about 30%. So interest rates have definitely moved into positive territory. A couple other areas I wanted to highlight for you, corporate profits. This has been a big driver of the market this year, and I've got a lot of questions about why we're in the yellow. Well, the trend has slowed a little bit. And I'm going to explain how we're seeing some margin weakness that could come through. And so right now we do expect earnings to stay high, kind of keep things moving in 2026, but we're just a little concerned about some of the potential weakness we could see in the back half of this year. So we certainly could go green pretty soon here on corporate profits, but we'd like to wait a little longer for confirmation on that before we move the speedometer. And the last comment I'll make is on valuation. So it's certainly, everybody knows it's been climbing here, but so has tech spending and revenues. So we really don't see valuation as an immediate signal to reduce equity exposure, but it does make us look a little bit harder at more fairly valued areas like small cap stocks and international markets. So we move into our forecasts. The big reveal here today is the 2026 forecast, and we think it's really going to be a beneficiary of three different things. So the first item is fading concern around tariffs. We also have a fiscal bump coming from the recently passed spending bill. And obviously, Federal Reserve cuts here are going to be a very powerful force in the market. And so if we start with GDP and growth, judging from the most recent report on GDP for the second quarter, and then looking at some indications now about higher than expected GDP in the third quarter, we do see some pretty strong growth going into the back half of this year. And we do expect to see a slight uptick in growth for the full year in 2026, potentially climbing above that 2% potential level. If we look at corporate profit growth, again, this is a bit of a tricky one for us right now. Analyst expectations always start high, and they certainly have been moving higher lately. Profits have been stellar this year, but we just want to see what happens with some of the margin pressure we see upstream. And keep in mind, too, that earnings have gone from about 14.1% in Q4 of 2024 to about 10.8% in the last quarter in Q2 of 2025. So still very good, but slowing a little bit. So for now, our midpoint is tilted slightly below consensus for 2026. Now on inflation, we're still out of consensus for the end of this year. We do see CPI moving higher in the fall and finishing above 3%. And given Fed cuts, we also think there's a chance that we're going to see inflation stay somewhat higher than we've been accustomed to. But overall, with some of the slowing tariff pressure, we do see CPI inflation by the end of next year between 2.5% and 3%. And to move on to Fed funds, we do expect to see another 50 basis points in cuts this year. Most likely, we're going to get one at the next meeting in October and another one in December. We think that's pretty locked in. But the path in 2026 is a little less clear. We could easily see 3 cuts, and that means policy rates would probably end somewhere between 2.75% and 3%. So with Powell exiting in May, the likely distortions from some government layoffs and reduced immigration continuing, we could see the job market give the Fed some more reasons to continue to cut. And this, above all, is going to be the biggest tailwind in our minds to the market. And then just to touch briefly on the 10-year, we do see an increased probability of longer-term rates going sub 4% as the Fed does cut, especially if the job market shows some additional signs of weakness. Now, for next year, we do expect stability in those longer-term yields, but we could see them falling a little bit closer to 3.75, and that will be a tailwind to bonds, and we do think overall yield levels will remain pretty attractive. So jumping right into the Fed, looking at a barometer of the current situation here, let's start with all these dots on the bottom half. So in the gray, we have the dot plot from June. The dark blue is what we just got in September. And most notably, what we can observe here is the majority of the committee did pull their expectation down to about 3.625 for the end of 2025. And that's right on the midpoint on our estimates between 3.5% and 3.75%. Now, in the big news, with Stephen Moran, the Trump appointee, joining the Fed, he was the one lone dissenter. So if you see that one low dot around 275 for 2025, he actually voted for a 50 basis point rate cut. And I think the fact that we only had one dissenter here, generally gives us some hope that the Fed does take independence seriously. There are plenty of members on the Fed besides Stephen Moran that are very friendly to Trump, but they were able to reach a consensus on this rate cut. So on balance, I think more Trump appointees do increase the probability of quicker rate cuts. But I do think the committee is going to try to hold on to that independence and make the best decision for the economy. And now, if we look at the top right box, it's a little strange to see cuts if we look at where the Fed projects the economy. So they're seeing higher growth, they're seeing lower unemployment, lower inflation, but also lower Fed funds. And so what this probably means is that the Fed does feel like they're a little bit behind. And we think this could be a little bit of a Goldilocks scenario for the market moving forward. So rate cuts into an economy where we have low recession risk, rising growth, and falling inflation could keep powering equities a little bit higher. So I do think we'll continue to see the market make new highs throughout the remainder of 2025. And so to jump into some of the risks, and I'm really going to focus in on inflation today, where is it? What's the biggest risk to it? Where is it going to come through? And so you've seen us do this before on webinars, but we're looking a lot at upstream inflation measures, so producer price inflation. So on the left-hand side here, you can definitely clearly see that companies are paying more. Import prices are now rising again. Those are the costs of imports before tariffs, so those pressures are alive and well. And if you go to the right-hand side, what was very interesting to us in the last report on PPI was the measure of trade services. It's showing some pretty interesting behavior. And so what trade services measures is the trade margin. So at what price did companies import a good, and at what price did companies sell that same good? That's that margin, right? So the last producer price inflation report, that margin shrunk. You can see that negative yellow bar right there. That's a concern for us because what it means is that we could have hit peak margins in the S&P 500. So the good news there, the margins have been very high, historically high. So there is some room for them to come down and stay above averages, but we're going to be watching Q3 earnings very closely for any signs of this pressure. And if it does go too far, we do think it could hurt the outlook for US equities, but we're not anywhere close to that yet. So moving on to our next inflationary concern, we're looking at the advance in housing prices. And this is known as shelter in the official measures. It has been on a downward trend since the Fed hit the top of the hiking cycle back in 2023. And so since the last hike on the right-hand side, we've seen housing slow significantly. So affordability is down, refinancing activity is down, and that's slowing down the price appreciation of homes across the country. And then rate cuts, especially if they're more on the aggressive side, could materially change this picture. So when we think about that trend, the shaded blue on this page shows just how important housing is to the level of inflation. It's about 40% of the top line number. And so because it's been slowing, it served as an offset to the increase in goods prices that are coming through from the impact of the tariffs. So if these rate cuts move forward and the trend changes, so housing stabilizes or prices start increasing more quickly in housing, this offset that we've had to goods prices starts to vanish. And so on the right-hand side, you can see those accelerating goods prices on the far right-hand side. So we do think that that's going to take consumer inflation higher. And it's the cornerstone of our belief that the market's probably a bit too complacent about inflation coming through to the CPI. And so we do view this as a core risk if and only if it's larger than we expect. But if you look at the positive benefits from rate cuts, elevated wages, and really no signs here of consumer distress, we do think the economy can withstand inflation between 3 and 3.5% in line with our year-end targets. So let's shift over to the market and talk a little bit about where we've been. And it really just keeps moving higher and higher. And last week, we saw a pretty rare event. There were a quartet of highs across the S&P 500, the NASDAQ 100, the Russell 2000, which is small caps, and the Dow. And so when you look across the US market, almost everything has participated in this most recent rally. And what's significant about that is it's only happened 25 times since the turn of the century, going back to 2000. So what it does confirm for us is our belief that rate cuts are the most powerful force out there to power the market higher. And more notably, what I also put on this page was the S&P equal weighted index. That's in the top right of this page. And you can see that it made an all-time high too. So we were broken records last year about the need for the market to broaden out. And judging by the equal weighted index and some other measures, it certainly has. So we've got broad participation here, which is very good for the technicals of the market. And so as we know, the biggest factor to the continued climb that we've seen is coming from technology. So what we wanted to do today is really check in on that trend. And the numbers are amazing. So you look at Oracle's backlog a couple of weeks ago, rose to over 450 billion. NVIDIA's most recent investment in Intel, we've seen a ton of activity lately. And if you look at the left chart, just at Mag 7 revenues, they've climbed above $500 billion a quarter. They even hit $600 billion in Q4. So if we compare that to GDP, that's an annual run rate of about 7%. And that can have a significant impact on the US economy's growth rate. And now if you look at the top right side, if we compare this spending level to GDP from previous episodes, so the advent of the PC and then on to the internet revolution, we're still a very long way off from the peaks if you look at where we are on a percentage of GDP with spending. And then the last component of this is if we look at generative AI and some of the forecasts that are out there in the bottom right, the AI revenue is expected to rise from about $300 billion in 2025 to about $2 trillion by the time we get to 2032. So that's another 7% of current GDP, potentially 7 years from now. So we do see this trend as being very alive. We think it's healthy, and we do think it's going to continue to power the market, certainly here in the near term. But let's talk about some things that are a little bit more off the beaten path and look at some positioning. So small caps and international markets, it's sort of been on everyone's, anytime you turn on a TV, it's kind of on the tip of everyone's tongue right now. But if we start with international, if you look at international stocks, they've outperformed this year through the low in the market in April, but the US has really gained some momentum back. And this can be illustrated by the green line on the left chart. So it moved lower, which represented international outperformance at the beginning of the year. And now it's moved higher, representing US outperformance. And so if you hold that thought on international, the other focus is on small caps. So if you look at that dark blue line, small caps trailed large cap stocks for most of the year until very recently. So since August 1st, they've actually outperformed the S&P by about 5.5%. So it's a pretty big jump here. And the most important elements to both of those markets going forward is what we've graphed on the right-hand side. So it's the direction of Fed policy, which we've discussed a lot so far, but it's also the US dollar. So let's pick back up on international and take a look at the behavior of those markets and the dollar. So the first thing I want to say with this chart, if you look at the green line, the benefit of not owning international stocks over about the past 20 years has been huge for portfolios. But the market can change, it will change, we know that. And so we have to look at the last time that international markets had a sustained run. And when it did, if you look at that box, it came in the wake of the tech boom and the September 11th attacks. And that's when the US market was really struggling. This strong outperformance lasted for about 5 years, but what was a necessary condition over this time frame was a sustained decline in the US dollar. And so over this time period, if we look at the dollar, it fell about 38%, and that's about 4 times further than where we are today. And it began to fall when the market hit its low in 2002. But if you exclude the impact of the dollar over that time frame, international actually barely outperformed the US. So let's take a look at some of the factors that were driving that back then. Now, I know I have 6 on the right-hand side. I'm going to go through 4 that I think are critically important. So the first is deficits. I've got current account and trade deficits. At that time, the economy was trying to recover. Fiscal stimulus was coming in. The Fed was cutting interest rates, creating bigger deficits. So we're definitely in that environment today. And we saw that at the beginning of this year with the concern level we had at that time. The next thing I've got on here is the China supercycle and growth shifts. So back in 2002, it was around the time that China joined the WTO, and that's when global trade really took off, and growth rates in emerging markets and international went up a lot. And so that really drove the decline in the dollar as there were more investment opportunities. Now, I think we have some of that today. We don't have anything on the order of the China supercycle, but we are seeing growth rates, especially in Europe, with the spending restraints sort of off, starting to increase faster relative to the US. They're still anemic in the absolute level, but they are increasing. I also wanted to note the euro formation that happened in 1999. So this was the first time that there was actually a real alternative to the US dollar. Now I've got this as yellow right now, but we see some of the similar behavior today, right? We've got digital currencies. We've got reserves shifting from hard dollar currencies into areas like gold. So some of that is starting to happen. And then the last area that I think is very important for positioning and diversification is investor sentiment and risk appetite. And so as we reach all-time highs, it's going to be impossible to know when we're going to pull back. But once a correction actually starts, it's often too late to make changes. And so if you think about investor sentiment and risk appetite, it usually craters very quickly into that type of an event. So in this scenario, we do believe that the likelihood of the dollar falling is high if markets were to come down here in the US. And so international markets do make a lot of sense in that context. And we also think the lower tech exposure that we see internationally will help offset potential declines in US markets. And that's going to help overall just to diversify risk. So it's not a foregone conclusion. We certainly don't expect the US markets to decline, but we do think the risk reward is getting more and more attractive as we move through the cycle. And so picking back up on small caps, I love this chart because I just think it's really simple. If we get into a cutting cycle, how do small caps do versus large caps? And so on this page, you can see the light blue line are small caps, and then the other lines are fast and slow cycles relative to the Russell 1000, which is large cap stocks. So we're in a slow cycle, focus on the blue line. What we tend to see after that first cut is an outperformance versus large cap stocks of about 5.3%. So we think this trend is alive and well. We've had massive outperformance in small caps since the low in April. So we think we're well positioned to catch that rally that we've seen. And so the last area I wanted to touch on, just to give everybody an understanding of where we are in our equity portfolios and some of our sector views, let's run through where we're overweight. So first and foremost, communication services and information technology, the tech sector, we are overweight as the market has run here. We talked about the demand surge for generative AI. We're seeing it filter through to other industries. It continues to really permeate what we do on a daily basis, and we have massive amounts of spending. So we think that trend for the time being is intact, and we're going to keep that on. But we're balancing that out with what we see in consumer staples and in energy. So in staples, those are companies that tend to be resilient to economic uncertainty. They're also defensive to slowing growth because you have to buy the things that they offer. And typically, they're very large and stable franchises with pricing power. So that bodes well in the inflationary environment that we could see. We're also overweight energy. Now, these have the cheapest valuations of any sector in the market. We've got some gyrations happening with OPEC that could reach some supply limits. And we're likely to see a reversal in some of the crude oil demand as we move into heating season. And that's sort of in the fall and the winter. So we do expect to see some good performance in energy. Now, where we're underweight are some of the areas that have really run. So in industrials, we do see some pretty stretched valuations after recent strong performance. Some of the manufacturing numbers aren't really coming in where we want them to be. And so as domestic growth kind of hits a trough year, that's not a positive tailwind. And then we do expect demand to decrease as input costs do rise as we see some inflation. And then last but not least, we're out of consensus with this on financials, so everybody's sort of calling for overweights here. We do see better profitability, but not enough for a big boost in lending spreads, so how they make money. And we also see less investment triggered by tariff headwinds at this point. And we do see a potential for widening credit spreads, so a little bit of a repricing in credit. So that's where we're over and underweight. So in summary, just to take you back through a couple of the points that we made, we do see the risk to the economic environment improving slightly as we enter this new easing cycle and have lower interest rates. That's absolutely going to help us, probably the biggest factor right now in markets. We do see growth expected to slow through the remainder of 2025 into kind of this 1.5% type of range. But we do see reacceleration by the second quarter of 2026. And that's going to happen when the inflationary effects of tariffs start to fade a little bit, and you have the positive influence of the fiscal spending bill. We do think the Federal Reserve is going to face some pressure from the administration. Most of members now, though, with the last meeting, do appear to be acting independently. But I do think on the margin, Trump appointees do increase the likelihood of a more dovish rate path. So I think the cut cycle is going to be with us through 2026. We talked about inflation and the impact from housing. That's going to be central to the outlook going forward. We're hopeful that that trend doesn't reverse so much that it really takes the level of consumer price inflation up higher. So that's the number one risk that we're watching. And then if we look at equity markets and turn to risk, broadly, they're very strong. We're seeing them at simultaneous all-time highs, and that continues to lead to market momentum, especially with the technology sector. And then on the international side, as we climb to higher and higher highs, we do see diversification potential and downside protection there, particularly if the dollar is in a weak environment. And then small cap stocks are having a really nice run here off the bottom on a relative basis since August 1st. So again, we feel like we're well positioned to take advantage of that. So I'll stop there and I'll pass it on to Paul.
That's great, Charles. Thank you so much. And the economy, as Charles just went through, is really in a great shape, much better view in terms of what's going to happen in the future compared to what we saw back in the springtime. We've always been consistent in terms of our view that the U.S. can power through this uncertainty, and we're starting to see it play through. We already know what the budget looks like for next year. Most of the trade deals have been established. There are still a few that are outstanding, but that will give consumers and businesses a lot more confidence in the future and much more willing to expand what they're doing. And we're already starting to see that, as Charles pointed out. That said, it's important to be paying attention to an awful lot of issues that are out there that may alter that trajectory. And that's how we spend an awful lot of our time. The biggest issue in terms of what we can focus on is global trade. The chart on the left-hand side just shows what world trade has been, and it's been consistently on a strong upward trajectory since we got past the pandemic period. You can see most recently it moved up quite a bit and has come back down, and that's really a result of U.S. consumers and businesses wanting to import an awful lot before the tariffs. You see the adjustment. The fact that the last month it's tapered that downward trend gives us some confidence that we'll continue to see an upward trajectory. The reason why this is important is, one, if the world economy is doing well, then the U.S. economy also will be doing well. But more importantly, as long as this stays on an upward trajectory, it sharply reduces the risk of seeing any retaliation in terms of a tariff war. We've seen this so many times in history. Once the tariffs get put on, once the country that has to deal with lower output and lower trade in terms of exports, they start to come back with their own tariffs. So the fact that we're on this upward trajectory gives us a great deal of confidence that we probably won't be seeing much of a trade war, if any at all. That said, we are seeing changes that are going on in trade. The chart on the right deals with China's exports. It's a little complicated, so bear with me just one moment. It's valued at 0 in October of last year. That's that vertical line that you see there. So that's before the election, before the world knew what would happen in terms of the risks of tariffs. The shaded area there that you see, that's the exports, the total amount of exports that China has. They don't seasonally adjust this data. So you can see in February of last year and this year, there's a sharp slowdown, and that really has to do with their celebration of the new year, where much of the country either slows down the pace of productivity or closes down temporarily, but of course it bounces back. But what you can see is from October of last year through August is that total exports from China is up about 5% or so. It's a little slower than what it had been averaging post-pandemic, but not by much. But what's interesting is where the exports are going. The dark blue line that you see there is exports to the United States. You can see that that's plummeted significantly. Where you see increases, and what's keeping exports strong in China is with the gray line. Those are going to countries that can easily export what they get from China to the United States. So they might be using something and then export it to the United States. And then the bright blue line, those would be other countries, much like the United States, like exports to Europe. So they are supplementing the drop-off of trade to the United States with areas outside the United States. The labor market is also something that's a concern, and we've been talking about this for well over a year now, mainly because of how hiring has changed, although it has stayed quite positive. Really, the big issue here is where we see the growth in hiring, and you can see this in the chart on the left-hand side, where the growth of the 11 major categories that the BLS pays attention to, that the ones that have shown the biggest growth, like education and healthcare and leisure and hospitality, these are non-cyclical sectors. They tend to have growth year in and year out, no matter what. A lot of it has to do with the fact that many people don't stay in that profession very long, or the fact that their demand is increasing, especially like in healthcare when we have an aging population. The reason why this is important is when you're looking at growth of an economy, what you want to see is growth in the cyclical areas, things like manufacturing or information technology, areas that will grow the economy at a faster pace. And those are areas actually where we're seeing declines going on. This has been going on for well over a year now. But what's interesting is how severe it's become. And you can see that in the chart on the right-hand side. The line is measuring the the monthly change in non-farm payrolls. But where we've broken it out of in terms of the bright blue or the light blue line that are columns that you see going on there, that's the education and health area, the strongest area of growth that we've seen so far. The the dark blue is everything else. And you can see in 4 of the 5 last months that we've had, that's been negative. So if it wasn't for the growth in education and health services, we would be having negative payroll growth. So you can see how that's changed. And this, of course, is what the Fed is worried about. This much lower pace of growth, the non-cyclical pace of growth, has forced the Fed to move their focus away from inflation in terms of trying to grow the labor. And the reason being is that labor and inflation react differently throughout the business cycle. Inflation tends to slowly move up and slowly move down. It moves in a big wave. Labor or the unemployment rate is much different in the aspect that once people start getting laid off, an awful lot of businesses lay off people, and it will shoot up quickly. And that's, of course, what the Fed wants to avoid. So the fact that they've already cut 25 basis points, they plan on cutting another 50 this year and more cuts next year, is telling us that that's a very good sign for the economy. They want to make sure that the demand for labor remains positive. And this is important because they've been faced with the fact that the demand for labor is a lot less than what they had thought beforehand. On the left-hand side just shows the annual revision that they make to the labor report. And you can see it's quite severe. It's telling us that for the year ending March of 2025, there's 911,000 less people working than they thought beforehand. Let me explain how this works. In terms of the monthly number that we look at, the Fed surveys over 600,000 business entities and government agencies. And from that, they find out hard data about 40 million people that are working. But that's only about 1/4 of the entire workforce. There's 160 million people. So they have to make assumptions based on the other 120 million. And a lot of that's done with modeling. And it's not overly sophisticated, but it's heavily data dependent. And generally, it's pretty darn accurate. But one cohort or one small group that they can't monitor very easily and have a great deal of difficulty is new businesses that are created and businesses that are closed. New businesses are hard to know. And this is what they call the birth-death adjustment. Birth being new businesses being created, death being businesses that are closed. So the annual adjustment that they use, they take what their assumptions are and compare it with tax revenue that comes in, specifically money that goes into unemployment insurance, because every employer has to do so for each employee. And that accounts for about 95% of all workers in the United States. So they calibrate it against that. And that's where these adjustments come in. And it's mainly due to the fact that, when a new business is started, the BLS doesn't know anything about it. They don't have the ability to send a survey to them. It's not until they get the tax records that they know that they exist. Furthermore, the surveys that they do send out, if they don't get a response, they don't know if that's because the business went out of business or they never got around to responding. So as a result, this birth-death adjustment has to be made. And this assumption is made, or the modeling is done based on history. But the thing is in the business cycle, as we move on, some years there's more businesses being created than those that are going out of business. And it makes it very, very difficult. So thus the need to do this annual adjustment. And this makes it pretty clear in terms of where we are working. Now, what does this mean for the labor market? Well, you can see over on the right-hand side, the dark blue line that you see, that's the change that's going on in non-farm payrolls. If we take into account the adjustments that we just learned about, that's the bright blue line, it's just showing that payroll growth is a whole lot slower than what it was at least thought beforehand. And as a result, that means it's much more closer to zero, which means that there's a greater chance that it might move into the negative territory. Thus, the reason why the Fed had to start using monetary policy in September instead of waiting till later in the year, despite the fact that inflation continues to remain well above what the Fed thinks it should be. The other issue that's going on is tariffs. Over on the left-hand side, the bright blue line that you can see is the amount of money coming into the federal government. The shaded area is also what's coming in terms of the amount of money. And you can see it's about $150 billion. On a yearly basis, the expectation going forward is that the government will be bringing in about $300 billion in revenue from these tariffs. That's a lot of money. To put some perspective on this, we paid $2.5 trillion into income taxes. So this is representing about 12% or so. So you can see that's a large increase in revenue. How much of that's paid by consumers with higher prices versus businesses that are absorbing some of this versus the risk or possibility that exporters might be bringing products into the United States a little lower in cost to try and offset it, makes it difficult to figure out what the economic impact will be. But it is quite severe no matter how it plays out. But the thing is yes, it is higher prices, but remember, we've lived through higher prices. As Charles said earlier, in terms of our outlook, we expect inflation to move forward, but it's nowhere near that 9.1% that we saw back in 2022. The world's different compared to what it was then. People are more conscious about prices versus back then, but we think we can power through that, but it is significant. One of the main reasons why we think we can power through that is the change from the 2026 budget, which is also stimulative in many ways. And you can see that on the right-hand side. The stimulative part is that sort of blue-gray, that's in the positive territory. The tariffs, by and large, is what's being shown in the bright blue in the negative territory, and the net effect of the budget. And as you can see, it is considered stimulus over the next few years. Then it becomes restrictive to policy. This is not new. Politicians do this all the time. They always make it look far more attractive in the next few years, and the cost gets embedded further on down the road. Now, Consumers, this is the most important part. And this is really the exciting part in terms of what we're seeing in terms of being able to drive the economy. I mean, because we know consumption makes up about 2/3 of GDP. So it's important to follow how that's doing. The biggest driver of consumption is, well, do people have money to spend? And if they do, then they tend to spend it. If they don't, do they have access to credit? If they do, well, they tend to utilize that. But the chart on the left just shows the disposable personal income per capita. This is the amount of money that you have to spend after you've paid your taxes. And for the 10 years before the pandemic, it was pretty linear in terms of its growth. But look at it since then. It's well above that trend line. That's telling us that people have an awful lot of money. Either they're continuing to earn it at a stronger pace, or they've been able to save up enough or use that for investment to create more wealth for themselves. So that gives them the fundamental background to be able to spend money. The question is, are they? Well, normally we show the personal spending number because that's the number that shows spending on goods and services and feeds into the GDP number. The problem is that doesn't come out until the end of the month. But mid-month, we get the retail sales number, which measures spending on goods and also restaurants. And mainly that's what we're worried about. Are people continuing to spend money on goods? Because that's the part that's impacted by the tariff. And here the news is good. It's a complicated chart. Let me just explain it to you. The columns are the monthly change, and you can see the last 3 months have been positive, reversing what was going on in April and May where they were negative, and that's the time when the tariffs were announced. The bright blue line is showing the 3-month change, and it's annualized to make it for an easy comparison. And you can see that we've seen a sharp increase in that. That's the biggest increase actually we've seen since 2022 when spending was quite robust. And it's pushing up the year-over-year number. More importantly, today, the GDP number that came out showed that personal consumption in the second quarter was a whole lot stronger than what was believed beforehand. It grew at 2.5%. The previous view on that was just 1.6%. So this is telling us that the consumer has moved by the uncertainty regarding the tariffs and continue to be spending money, which will help drive economic growth. And this is important because those numbers are just showing the total averages of all of that. But in terms of how people spend money, the chart on the left, we've shown this in the past in terms of, you can see 80% of the spending is done by the top 40th percentile, those in the 60th to the 100th percentile. Whereas the bottom 40th percentile, you can see, do only about 10% of the spending. The fact that the economy has benefited greatly to those at the higher end of the spectrum, and the fact that they tend to own financial assets, they tend to own a home, both have increased significantly. The fact that if they have a mortgage, they probably refinance it to reduce their costs. This will continue to drive spending in the United States. But what's interesting is the change that we've seen go on since the pandemic. And most importantly, it's a continuation of the long-term trend. The top decile, those in the 90th to the 100th percentile, currently are doing 50% of the spending. Look at where it was in the 90s. It was down at 35%. So they've gone from about 1/3 the spending to half the spending. And this, again, is the driving force of the economy in terms of its consumption, is the fact that those at the higher end of the income spectrum can afford to continue to do their spending, and thus they're less cyclical and thus help drive economic growth in the long run. And we're starting to see this in some other sources of consumer sentiment. The dark blue line on the left-hand side that we tend to follow and have been following is the standard from the University of Michigan. I'm sorry, not the dark blue line, bright blue line, excuse me. The University of Michigan number has not been consistent with what we're seeing in terms of how well the economy has performed. You can see that before the pandemic, it was at a much higher level, around 100, fell pretty significantly in 2002 as an all-time low, and is still pretty low. Yet the economy is doing extraordinarily well in terms of the amount of people that have been hired, in terms of the wealth creation. So it's fallen out of favor. For the past few years, we've been following another one and just using it for comparison in terms of taking a look at sentiment. And this is from the Morning Consult. This is daily, which is far more important than the monthly number that comes out from the University of Michigan. but it's showing a trend that's much more consistent with that of how the economy has been performing. And it has been performing quite well, especially since 2002 when inflation was very, very high. But when you look at a breakdown of what sectors are performing well versus others, what cohorts view this as a much more positive economy, you can see it on the right-hand side. The dark blue line is those in the top third of the income spectrum. Those in the gray are the middle third and the bottom third. And it's the top third that it's really what's the driving force behind it. Just what I was saying on the previous page. This is the group that have benefited greatly from price appreciation of financial assets in homes. And that's why we see this on a positive upward trajectory. Well, it's coming up to the end of the fiscal year, and there's a risk that the government might shut down. This is a regular event for us. This is the time when the party that does not control the White House can flex some political muscle and try to push through part of their agenda. This is not like the debt ceiling. The debt ceiling has a great deal of financial and economic risks to that because there's the chance that the U.S. government would not make a timely payment on a debt security or payment that they have. This is just the government having to shut down until they can figure things out and then reopen. The biggest issue, of course, is always talked about is the deficit. It seems like this is the only time that they care about the deficit. On the left-hand side just gives a breakdown in terms of how well the deficit has grown in this cycle compared to past cycles. In this cycle, that's the bright red. The blues that you see, that's when spending was quite severe. That was during the pandemic period. And the greens are all the other years. The bright light green at the top, that was before the pandemic, the other green lines that you see. It's pretty consistent in terms of growth, in terms of the deficit. We continue to see a stronger and stronger amount of spending relative to revenue. So the deficit continues to grow year in and year out. We've seen shutdowns in the past. You can see it from the right-hand side, how long they tend to last. When they get very long, like the most recent one that we had back in 2018, at that point it does impact GDP usually by 1/10 or 0.2%, but it tends to be brought back the following quarter. So the economic impact is short-lived. Most of that is a result of the fact that consumer confidence falls quite a bit and shopping spends cuts down. But like I said, it tends to bounce back. So the economic ramifications of this, it doesn't tend to be quite severe at all. Again, it's not like the debt ceiling. But in terms of the outlook and the key takeaways, I can't tell you how exciting it is that the Fed has moved their focus away from inflation to the labor market. This is very, very bullish for the economy that will continue to see growth. And just for the reasons that Charles was talking beforehand, in terms of the tax advantages for both individuals and businesses in the next fiscal year, the spending that's going to go, especially in the investment part of the part of GDP, this will be a big driving force for economic growth next year, and will get us back on track to the trend that we're on, like we were before all this uncertainty that came because of the trade issues. In terms of the inflationary pressures, well, this will probably slow down the ability of the Fed to bring inflation down to 2%. It was on that downward trajectory before all the tariffs started to kick in, and we assume that it'll continue to be on that downward trend, and the Fed knows that. Their biggest issue is inflation expectations. People expecting inflation to remain high, meaning they'll demand more salary and larger salary increases. That probably won't play out in terms of what we've been seeing so far. The demand for labor should start picking up again because of businesses investing in their future. But the sentiment issues continue to be something that is difficult to reconcile. Sentiment does tend to be lower than what we had during the pandemic period, but by and large, the economy is a whole lot better than what it was beforehand. So we remain that positive attitude on the economy. Again, a slower pace of growth this year, but a rebound next year to a much stronger pace. So let me turn it over to Mike and give us an update in terms of what's going on in the bond market. Mike?
Wonderful. Excuse me. Thank you so much, Paul. And hello, everyone. So today, why don't we start with the yield curve? And so on this page, the dark blue line here shows Treasury yields at the start of the year, while the light blue line shows them as of last week. And then we have this gray shaded area, which represents the range of where yields have been over the course of the year. And what we see here is that early in the year, as investors were really concerned about policy uncertainty and expanding deficits, we saw yields move broadly higher, with the 10-year reaching roughly 4.8% and the 30-year peaking at just over 5%. But as the initial uncertainty has faded, and we've had some concerns about the labor market, and then the Fed has started to normalize rates again, what we've seen is the curve has gradually shifted lower. And so when we look at this, there's really two takeaways here. First, this has helped deliver very, very good returns across the fixed income markets this year. And second, even though yields are lower by about 50 to 70 basis points across the curve, we still see opportunities where yields remain historically high and attractive, and they're positive once you adjust for inflation. And so looking at returns, we see that emerging markets and global investment grade and high yield are the top performers this year, with returns in the high single digits. And performance here has been driven by a number of factors that include heavy demand and tight spreads, but the declining dollar has really magnified these returns this year. And then if we look at the US markets, investment grade and high yield are roughly neck and neck here. And we see a similar story with heavy demand and good credit fundamentals, and a little more spread tightening in the investment grade space than what we've seen in high yield. And then if we look at the end of this chart, what's really nice to see is that investment grade and high yield municipals are now positive on the year. And so while shorter maturities have consistently done well this year, it's been the long end of the curve that's really been challenged. And what we've seen so far this month in September is that it's really found a footing. And so for context, if you look at the market through the end of August, high yield municipals, for example, were still negative by about 1.3%. And so now you can see that we're in positive, solid positive territory here. And then if we look at the light blue bars, these represent the intermediate or 1 to 10 year corporate and municipal segments of the market. And we highlight these here as a reference point because this tends to be where investors have the greatest exposure. So very good returns when you look across the curve in the various asset classes this year. And so if we turn to the high yield markets, and a lot of the story here has really been about credit spreads. And remember that credit spreads are really that extra yield that's required by an investor to take on risk of owning something that isn't a US Treasury. And so the chart on the left here, it shows that spreads widened early in the year, but again, they've retraced a lot of that movement and are now at about 240 basis points. So we're really at the low end of the historical range. And so while valuations are a little bit tight here, they have been supported by strong balance sheets as well as favorable technicals in the form of heavy demand. And that's simply because yields have been, very, very attractive. And then on the right, we show coupon rates. And this is simply the amount of interest a company has to pay in order to borrow money. And what we see here is that interest rate or interest expense, it's shifted higher as rates have gone up. And so as we look at the market, we really have to be mindful of the potential for widening spreads. So on the one hand, we have higher interest expense that can chip away at fundamentals. And at the same time, we have tight spreads that suggest the market is really pricing in Fed cuts here and some relief that's going to come in the form of lower rates and cheaper funding. And that in and of itself could cause spreads to widen a little bit, just naturally on the margin here. And so while we think we're in a good spot presently, but we're in a good spot presently, but given how tight spreads are, across our strategies, we continue to remain market neutral with our exposure to corporates. And then looking at the muni market. And so I mentioned that prior to this month, longer maturity municipals have really struggled this year. And heavy supply has been one of the factors that have been pressuring the market. And so here we break down the supply dynamics, and we can see that supply can come from new issuance. It can come from refunding or refinancing of debt that's already outstanding, or a combination of the two where some old debt is refinanced and a little bit more is added to the deal. And so what we see is that supply is up about 20% versus last year, and it's about 40% higher versus the 5-year average. And so what we need to understand here is that this isn't a sign of credit stress in the market. It's really been driven by a couple of things. So early in the year, we had issuance ramp up on fears that the muni exemption could be eliminated. We also have seen this increase in supply as rising infrastructure and capital project costs have started to increase from inflation. And then we've also seen this need to replenish budget gaps as pandemic aid has wound down. And so, while this supply has been met with really good demand on shorter maturities, longer paper has met with a little bit of resistance here. And ultimately that caused the long end of the yield curve to steepen. It caused valuations to become quite attractive. And so far this month in September, we're seeing buyers have stepped in full force here over the last couple of weeks to really take advantage of this. And so while it's been a little bit of a bumpy year this year in municipals, overall, we're looking at this supply story of something that's actually very good for the market. The market hasn't grown in years, and demand has been consistently strong. So while it's been a little bit of a rocky start, we think long-term this is good for the muni market. And so turning to emerging markets, and here, as a firm, we do have a history of investing in this space, and exposure will typically come through an allocation to opportunistic income. And so the chart on the left here, it shows one of the reasons why we think this is an attractive asset class. And you can see that emerging market yields are meaningfully higher than US investment grade yields. And this provides a compelling income opportunity when looking to invest beyond or to diversify beyond developed markets. And then if you look at the chart on the right, what we see is the spread over treasuries have moved meaningfully lower this year. And so this move tighter, it's been driven by improving fundamentals, strong capital inflows from investors looking for yield, and then again, weakness in the US dollar. And so if we start with this higher level of yield that we're earning, and we add to it the same type of spread tightening that we're seeing in the US markets, this is really combined to deliver some of the best returns across fixed income this year. And so again, this has been a core part of our portfolios, and we do continue to like exposure to these markets. And then another area of the market that I wanted to touch on is private credit, because it's really received a lot of attention recently. And when we talk about private credit, we're really talking about lending by non-banks like asset managers and fund companies. And this is lending directly to an end borrower as opposed to debt that's being issued through public markets. And so investors in this space, they're compensated with higher yields versus what you see in public markets and tend to have stronger covenant protections, but you give up a degree of liquidity and transparency. And so if we look at the chart on the left, what we see is that credit losses for direct lending over the last 10 years has been in line with or slightly better than other high yield credit markets. And so while defaults have been comparable, if we look at the chart on the right, we see that returns have been the differentiator here. And so here we see that over the last 10 years, direct lending has annualized about 9%, while loans and high yield have been around 5%. And so more recently, we're starting to see a little bit of pressure build in this market. And so as we look at the asset class, we think one of the main issues here is choosing the right partner, and that is going to be essential. So there's been this emergence of new managers in the space, and some of them have yet to go through a serious credit cycle. And so when we think about the market and where we invest, it's usually in those blue chip names with managers that have experienced those credit cycles before. And so we like this as part of a portfolio because of the volatility and the risk characteristics. But again, it's really about experience and expertise here that is going to be crucial going forward. And then finally, here we look at a few scenarios that suggest bond markets might have a little bit more room to run this year. And so again, we're looking at those intermediate sectors of the market or segments of the market. So intermediate munis, corporates, and treasuries. And here we're modeling 2 more rate cuts by December. And we see that the 10-year remaining unchanged, dropping a few basis points to about 4%, and then dropping to about 3.75. And so if we look at intermediate corporates, for example, through yesterday, the market has returned just under 7%. And if we're to look under the first scenario, if the Fed moves an additional 50 basis points and the long end of the curve remains relatively unchanged, we could add another 1.4% in return this year. And then if we look back at that total return chart that we started with, we can see that there's this potential to build on what's already been an excellent year, and for some returns to hit in the low double digits for certain areas of the market like high yield. So overall, it's been a very good year for fixed income. And so to summarize, falling yields have really helped deliver strong fixed income returns so far this year. Global markets have outperformed the US markets with the help of a weak dollar. After trailing much of the year, municipals have recovered significantly this month. And then overall attractive yields, tight spreads, favorable technicals we think will continue to provide support to the market, but we do remain cautious on where spreads are today. And so with that, I will turn it back to you. Charles.
I can jump in there, Mike. Thank you, Mike. And thank you, Paul and Charles, for that great presentation. I think we can get time for some questions. And just as a reminder, if you do have more questions, you can input it into that Q&A console on the screen. I'm going to start with you, Charles. You mentioned a couple times about stretch valuations in equity markets, and we've all seen markets at or near all-time highs. So the question is now a good time to reduce equity exposure in client portfolios?
Yeah, it's a great question, Matt. And I think it's pretty much the first question I get from any client presentation or meeting I go into these days. And I think what we need to keep in mind is that, valuation over time has been a very, very poor predictor of returns. It's a longer term indicator. And so we could get into a situation where the tech situation today runs for another 6 months. It could run for another 3 years, right? And so from what we look at and what we see in terms of market leadership, we do see that trend staying intact. So we don't see any near-term risks from the level of valuation. We're a little bit more concerned just at the aggregate level of making all-time highs and continuing to do that. And then some of the geopolitical as well as inflationary and tariff risks that we see out there that still could rear their head. So valuation alone isn't the only reason we would be reducing equities. If we felt like the return potential and some of these outside risks were really going to be a threat, then we'd start making reductions. But we're just not there yet.
Understood. Thank you for that. Paul, we've had a couple of questions in the chat about tariffs. If you could make a comment that now that we have most of the tariffs in place, what's the expectation for U.S. manufacturing? Do we expect it to start to take off here?
Actually, manufacturing in the United States has been on an upward trend for about 2 years now. It really hasn't caught on in terms of increase in labor. In fact, it tends to decrease. But an awful lot of the manufacturing that's done in the United States is stuff that's done by a well-educated workforce where there's a great deal of gains in productivity. So that's why we are increasing the total amount of output. The tariffs by themselves probably won't change that story much. A lot of people are not going to want to produce things domestically just because they have to pay 15% or so more for a good. They'd rather just import it because remember, the tariffs were just signed into law by a president. They can easily be reversed by the next president. So setting up manufacturing in the United States just based off of the tariff, probably not much of an issue. But what we are seeing is increases in the sophisticated areas, especially in technology and pharmaceuticals, which we're trying to repatriate.
Mm-hmm. Great, thank you. Mike, if I could bring you back in for a second, people think about our rate outlook and that helping asset prices, but a question on reinvestment risk. If rates fall and investors may miss out on the higher interest rates that we've been enjoying over the last few years, how do we protect clients against that reinvestment risk?
Yeah, that's a really great question. And, I'll start by saying, for some time we have been talking to clients about reinvestment risk, and it starts with a lot of clients that have very short duration portfolios, or for somebody that might have large cash balances. And so we have been saying that if you don't have an immediate need or you need immediate access to this liquidity, push out the curve a little bit, lock in some yields where it might make sense. If you can target those future cash needs. But as Charles showed earlier, with the Fed's longer term target of about 3% or so and bond portfolios, they could be subject to reinvestment risk. So, we do think it makes sense for clients to revisit their fixed income strategies, look at their risk tolerance, look at their time horizon. And in many cases, some maturity extension, may be appropriate to protect against that risk.
Got it. Thank you very much. With that, it looks like we are at the hour. So I just want to thank everybody for joining us. And a reminder, a brief survey is going to pop up on your console. Please share any feedback that you may have, any suggestions for future topics. A replay of the session will be available within the next 24 hours, and you'll receive an email letting you know how to access it. So with that, thank you, and have a great day, everyone.